but let's return to order. Thank you so much for joining us for the last session of the day. Apologies that I'm wearing a mask. This is a sort of funny situation. I'm at home, but there is someone doing repair work, and so with apologies, someone let me know if I'm too muffled. Anyhow, so today's session, or this session, is on design and usage of tokens. And it's a really interesting suite of papers that, in my view, attacks sort of, the two dual and closely linked questions about how we should be thinking about, sort of large-scale infrastructure layer token design, right? Like I'm a great believer that there will be infrastructure layers of transaction, for transactions built on some variety of, current or future blockchain technology. And there are two questions if you're going to build such a thing. One of them is how you should structure it, right? What is the proper design for infrastructure? But then secondarily, it's like, what should that be used for? And how should we think about the relation between the use cases and the underlying structural designs? Like, these are not disjoint questions. Lots of people think of them as independent questions, but they're really not. They're sort of, pun not originally intended, two sides of the same coin. Because the different use cases you imagine have a lot of bearing on what sorts of stresses your infrastructure layer has to be able to, withstand, and which sorts of, transaction features and programmability are most useful. And similarly, the type of infrastructure layer you build, like what you enable your tokens to do, of course, explicitly determines how they can be used. And so we'll see, we see papers that, look at specific use cases or applications, or sort of posit the existence of a particular model of what the infrastructure layer could do and how. And then we'll sort of phase from there into thinking about, what that implies for the underlying designs. In particular, towards the end of the session, we'll come to this tension between the store of value and medium of exchange, which I myself am particularly interested in and thought a lot about with my collaborators, Christian Catalini and Ravi Jagadisan, that when you're trying to build a token that's primarily a medium of exchange, you need a lot of sort of liquidity, related tools, right? You need sort of a lot of opportunity to enable people to transact. But those same things that make a token very liquid, sort of change the extent to which it's useful as a store of value. And, also you sort of change the security state and how well, sort of how well you can protect your system. And so you really need both of these uses, but there's this tension between, the two uses sort of being in conflict. People who want to store a value are trying to stockpile, people who want a medium of exchange are trying to make the thing as liquid as possible. And so we'll come to that sort of balancing question. And then, and then at the very end, sort of we'll have a lot of fun talking about ICOs. Perhaps the authors are going to issue one, in the middle of the talk or something of the sort. In any event, so that's our rough intro, intro to the lineup. We're talking about infrastructure layers, and throughout the session, how should we design the underlying token technology, and how does that interact with what it can and will be used for? And our first paper is Best Before, Expiring Central Bank Digital Currency and Loss Recovery. And I believe the presenter, and apologies in advance, I forgot to collect name pronunciation. Speakers, please private message me your pronunciation. But with apologies if I get it wrong, Yu Zhu will be our first speaker.
And you are muted.
Okay, sorry. Thanks, Scott. That pronunciation was great, and it's very good. We just come back to this. Okay, so first I would like to thank the conference organizer to put this paper into the wonderful program. And this is a joint work with Charlie and Martin Van Noort. And Martin is online, I think, so he should be able to answer questions in the chat. So in this work, we are thinking about using using an expiry date to facilitate loss recovery if the central bank digital currency allows for offline payment feature. We are talking about central bank digital currency because Martin and I are working for a central bank, or Martin was working for a central bank, so we think about the design, but actually the central bank part is not that important. It's really about using expiry date to facilitate loss recovery, okay? So let me just jump in. Important advantage of physical cash is its resilience. It can be used even if there is no internet and no power. This is quite useful for remote locations and in case of natural disasters. It would be desirable to have the same feature in central bank digital currency. In fact, several central banks have been thinking about that too. But an implication of that is really the balance that can be used for offline payment has to be stored uniquely in a tamper-resistant device and has to be separated from the online balance. Well, why is that? This is really just try to avoid the double spending problem. So in the graph, I plot two types of stores. On the left-hand side, these are stores in the woods. They don't have instantaneous connection to the central bank. And on the right-hand side, these are stores that can connect to the central bank instantaneously. And when we talk about offline payment feature, we are thinking about you can use it as an offline store that's on the left. But the issue there is because these stores don't have instantaneous connection to the internet, to the central bank, so they cannot verify whether the money has been used or not. So if you can store the same offline payment balance in two devices, you can go to one store, use one device, and then go to the other store, use a different device, but with the same balance. So you use that balance twice. And these stores cannot instantaneously check that open store to double spending problem. Similarly, if you can use that same balance online and in an offline device, you can do that, spend that money offline and online at the same time. So that also opens door to double spending problem. So to rule out this possibility, that means we have to store the balances uniquely in a tamper-resistant device. And that has to be separated from funds that can be used online. That leads to a problem. That means if you lose a device, you lose your fund. Then the loss problem just happens. So in this paper, we're thinking about whether we can reduce the cost of loss in central bank digital currency or in any digital currency. The answer is yes, we can do so with an expiry date. The idea is that if we download money to the offline devices, there is an expiry date attached to it. You can think about it as there is also fund online that's locked, attached with exactly the same expiry date. Then if the central bank does not detect anyone claims that fund before the expiry date, then that money is automatically reimbursed to online accounts. So basically in that case, the central bank infers the money has lost. Okay, it turns out this leads to some interesting economic trade-offs that we analyze in this paper. Okay, sorry. Here is a summary of what we find. First, we find that the loss recovery with expiry date can substantially increase the demand for offline balances and can increase welfare. And this is intuitive because that reduces the cost associated with the loss. So people bring in more balances that allows them to consume more, which is good for welfare. Second, we look at what's the optimal duration to expiration. So how to set the expiry date optimally. That needs to balance two things. One is the time. One needs to wait to get the lost money back. The other one is you have to leave enough time for the merchant who accept this offline money to deposit it. So the optimal expiry date balances these two. It turns out there is also a asymmetry there if you deviate from the optimal expiry date. If you set it slightly too long, that really does very little to the welfare. But if you set it too short, that's really bad. The intuition is if you set the expiry date too long, what happens is that if I lose the money, I have to wait a bit longer to get it back. But because I'm patient, that doesn't mean much. But if I set it too short, what happens is that sellers will realize that they would not be able to deposit it before it expires, then they will reject this money. As a result, there is no transaction, which is really bad. We also think about the information about what type of information the offline device should share with the central bank. Should it share more information? That means reveal the transaction history of the consumer. Or it should provide that, it should share less information, not sharing the transaction history. And it turns out more information sharing improves loss recovery and accuracy, but can reduce welfare. I will talk about that later. Okay, so in the model we have, in the paper we have a small model to illustrate the key trade-offs, and we have a bigger model, infinite horizon model to just quantitatively assess the optimal expiry date. During the talk, I'm going to show you the small model where we illustrate the trade-off of expiry date in a simple for period setup, and we are going to focus on the outage event in case there is an outage that disrupts the network. So when I say cash during the talk, I really mean some offline balances that can be used for transactions without internet. It can be stored value in a payment card or a smartphone chip. As I said, this allows for payments during outages, but is subject to losses. So the model is quite simple. At time zero, the consumer decides how much cash to hold and how much online balances to hold. And the online balance pays some interest, but the offline balance do not. And after that, there is a random preference shock realized. The consumer may want to consume 1 or 2 units depending on the preference shock in period 1. Okay, at the beginning of the period 1, there are 2 independent random shock realized. First, an outage could happen. In that case, the network is down. Second, the consumer may lose his offline balances. And after that, the consumer buys goods from the producer, and he can use online deposit if there is no outage, but he can only use offline cash or offline payment balances if there is an outage. And the consumption is bounded by the available and usable balances he has. This is standard caching and once constraint. And at the end of this period, if there is no outage, consumer can deposit offline cash back online just to earn some interest. At period 2, first outage ends if there is one. After that, the producer may also lose his offline cash with probability eta. And then agents can withdraw and deposit cash and online payments arrive. And time 3, everybody just go home and enjoy counting their money. Okay, so let's first look at what happens if there is no expiry date. That's like a physical cash. Once the offline balance is lost, it's lost. You can never get it back. In that case, the producer will accept the cash during the outage, and the consumer would decide how much cash to bring in, depending on whether the benefit exceeds the cost. The benefit comes from the fact he can consume more in an outage if he brings more offline balances. The cost comes from the foregone interest and cost from and the loss event. It will bring in enough for the second unit under a more demanding condition. This is because he always consumes the first unit, but only with some probability he wants to consume the second unit. As the social welfare is increasing in consumption. Okay, now suppose it is an expiry date, but it's set too short. It really is the cash expires at the beginning of the period 2 before the producer can deposit. In that case, the depositor don't have a chance to deposit, the cash will be automatically reimbursed back to the consumer. Then producers realize they cannot get the money, so they reject the cash and no transaction will occur during an outage. So the social welfare actually goes down if you set an expiry date that's too short, that's too early. Now, what happens if we have a longer expiry date that lasts for 2 periods? In that case, there would be transaction. In fact, the terms of trade during an outage would be the same as if there is no expiry date. And in terms of cash holding, consumers will want to hold more cash under certain parameters because the cash of a loss is reduced. Now he can get the money back if he lost it, but only with some delays. This would improve social welfare under certain parameters. Okay, so far I'm talking about the low privacy case, the high privacy case. Now thinking about the low privacy case, if the consumer connects his device to the internet, the device reveals his payment history. In that case, what happens is that if the seller, the producer lost his device, but the consumer connects his device, the central bank knows that the consumer has already spent the money, then it's gonna be the seller or producer lost his money, then the central bank reimburses the money back to the producer, not the consumer. In that case, the consumer will have a choice to make whether he wants to reconnect or not. If he spent all his money, then he does not want to reconnect because he just wants to bet on the seller lost the device and he can get his spent money back. But if he has unspent cash, then he has a trade-off. If he reconnect, he can get an interest on the unspent cash. But if he does not reconnect, he can get his spent cash back with some probability. At the end of the day, it's really depending on which one is bigger. If the interest is higher than the loss probability of the seller, the consumer would reconnect. As a producer realize that they see they have an extra insurance, even if they lose a device, they can get the cash back. Hence, they will reduce their price of their goods. This reduces how much money or cash the consumer would need to bring in. Under certain parameters, this increases consumption and will improve social welfare. However, if the interest is lower than the loss probability, the consumer then will not reconnect. That means he would not earn interest on his unspent money. That increases his cost of bringing in precautionary cash holding. Therefore, he would bring in less, and as a result, consumption becomes lower, and that could reduce welfare. Okay, that's all I wanted to say. Just to recap, we find loss recovery is helpful both in, with an expiry date is helpful both in increasing demand for offline payment balances and in welfare. And there is a symmetry in setting the optimal, in setting expiry date. And lastly, more information sharing improve loss recovery accuracy, but can reduce social welfare. That's it. Thank you.
Awesome. Super cool mechanism and really interesting asymmetry point. Let's thank the speaker. I'm going to applaud on Audible. Everyone else, please do so, and get some applause emotes in the chat. I think we have time for one question if anybody wants to ask a quick one. All right, let me ask very, very quickly. So taking the asymmetry into account, do you have a sense of how we would actually calibrate the expiry time in practice?
Oh yeah, we actually did that. in the paper, we
amazing.
have a dynamic model, and we don't really calibrate the expiry date. We calibrate some like loss probability and utility function of consumers and stuff like that. And then we solve the model and pick the expiry dates and maximize the total welfare during the outage. It turns out it's, given the parameters we get, is about 20 days or something, slightly longer than 20 days, 20 to 25 days. I can't remember the exact number, but we did that in the paper.
That's awesome. That sounds reasonable and totally practicable. Thanks so much. Let's thank the speaker once more. Let's get some emotes. And then up next, Michael Lee is going to be telling us about the optimal design of tokenized markets.
All right, can you hear me?
Yep.
Okay, well, thank you for including us in the program. This is joint work with Antoine Martin and Rob Townsend, and the views expressed here are ours and not necessarily that of the New York Fed or the Federal Reserve System. So let me start with a very basic premise. Suppose two traders agree to a trade. How can they ensure that in a future date that each party will actually make the transfers as promised? Now, this refers to a pretty age-old problem of limited commitment, and modern financial markets have figured out various solutions to this. We have third-party mediation, we use margin requirements and other forms of collateral, and we build long-term relationships and reputation in order to alleviate this concern. Now, at the same time, settlement fails or failures in settlement still occur. In fact, at the peak of the global financial crisis, $400 billion per day in settlement fails occurred in the treasury markets. Now, it was so severe that we had to implement some changes in order to try to reduce this, and we still have settlement fails continue up to this day. So this persistence of settlement fails actually is due to an institutional and technological feature of the current legacy system. And it's the fact that in the legacy system, individual traders are responsible for submitting instructions that correspond to their trading activity. Now, a clear consequence of this is that whenever incentives break down, settlement breaks down as well. So this kind of introduces a potential for a DLT-based settlement system to offer a technological solution. I'm going to refer to this as a token system. Now, the key feature here is the programmability of assets. Programmability can enable traders to commit to settlement at the time of trade, and it essentially collapses this gap that exists between the time at which you trade and the time at which you actually settle the transactions. Now, if implemented correctly, it could, in fact, eradicate the potential for fails to occur in the first place. So in this paper, we're going to consider a market where traders enter these interdependent trades in order to achieve the optimal allocation of a long-lived asset. And key here is that there's a limited commitment problem. Sometimes traders are tempted to break contracts after the time of trade. And what we want to do is compare equilibrium trade and settlement under the legacy and the token system. So the main question is really, does the token system strictly improve upon the legacy system? And we'll show, actually in a setting with endogenous trading, not necessarily. Now, this is striking because we think if settlement fails are costly, then it should be quite obvious that it should improve. And in fact, it's because even though a token system can eliminate settlement risk, a new information problem emerges. And this is because the token system implicitly requires traders to reveal a little bit more information about their position. Now, the intuition is actually really simple but powerful. Think about A and B, who agree to trade in a token system. So A and B can bargain, negotiate, and they jointly write a program that governs the future ownership of the asset so that the asset will be settled in the way that they've agreed upon. Now, what happens in the process is that traders must, however, have the ownership rights to the asset at the time that settlement takes place. In other words, they need to be the owners of the asset in order for them to actually program the asset. Well, actually knowing that the trader owns the asset is a form of information that doesn't arise in the legacy system. And because of this incremental information, it can actually aggravate a holdup problem and even break down trade altogether. So in the time remaining, let me go through the model and provide more precise intuition on exactly why this occurs. So we have a very parsimonious setting with 3 risk-neutral traders, A, B, and C. And there's a single long-lived asset that's initially owned by A. So A is the initial holder of the asset, but these traders have period-dependent payoffs from holding the asset. And this means that they have a reason to trade. Now, the model has 2 stages. In the first stage is what we call the trading stage. There are bilateral meetings between traders, and they get to negotiate transactions or transfers of the asset over the time periods of 1, 2, and 3. Now, in the settlement stage is the period or the stage where the actual transfers of the asset actually takes place between the traders. So if we start with the trading stage, there's 2 meetings that sequentially occur. It's either a meeting between A and B or B and C. Now, importantly here, the orders are random and they're only known to B, and B is the one that participates in both meetings. So here, A and C never meet. And you can see here that B has to act as an intermediary between A and C in order for C to obtain the asset at any time. Now, in a meeting, traders are negotiating a securities lending contract over the 3 periods, 1, 2, and 3. An example is A can lend the asset to B in the first period at some price P. So after the trading stage, there's some trades that specify some transfers that A, B, and C agreed upon over time 1, 2, and 3. If we go back to that example, when A lends the asset to B in period 1, there's 2 actions that are corresponding to this. A needs to transfer the asset to B at the beginning of time 1. B needs to transfer the asset back to A at the end of time 1. So in the settlement stage is exactly when these actions are going to take place. And we're going to consider 2 systems, the settlement under the legacy system and the settlement under the token system. So in the settlement in the legacy system, as I described earlier, assets move out of an account only if the owner of the account initiates a transfer. This simply means that at the time that a transfer has to take place, agents or traders have to take specific actions to do so. Now, this means that settlement fails can in fact occur, and what kind of may hold them back is the potential that there is some kind of penalty associated with failing to do this. You can think of this as a reputational cost associated with failing to settle on time. Now, in contrast, in the token system, bargaining and programming occurs simultaneously as if it's immediately settled. You can think of this as settlement instructions that are self-executing. So these assets are going to move across these accounts without any trader's actions, as stipulated by a trade. But it also means that traders can't intervene in this process. Now, there's a basic condition here, and it requires that the traders have to be the current holder at the time that the contract specifies the asset to be transferred. They need to have the rights to program the asset. And this means that both parties know that the conditions of the trade is satisfied, and for example, A must own the asset to lend the asset to B, and B actually knows this in the process as well. So the final piece is the traders' payoffs. We have that each agent, there's a maximum payoff attributed to one agent at any given period. In particular, B has the highest payoff from holding the asset in the first period. C has the highest payoff in the second period. And A, who initially starts with the asset, has the highest payoff in the final period, implying that A would like to obtain the asset in the final period. Now, this implies that there are 2 trades that we would like to have occur. We want A to lend the asset to B in the first 2 periods, for B to lend the asset to C in the second period, and for the asset to return back to A in the third period. The question is whether this will actually occur in equilibrium. So let's think about the 2 key tensions that are embedded in the model. The first is the obvious limited commitment problem. Now, the limited commitment problem arises because some of the traders, in particular C, learns his true valuation of the asset after the time of trade. In particular, at time 3, C sometimes highly values the asset with some probability. And this means that whenever C privately learns later on that he values the asset highly, if he has control over the asset, he wants to hold on to the asset instead of returning the asset to B. Now, the second tension is this latent holdup problem. The key here is that C depends on B to obtain the asset in any given future period. And because trade occurs asynchronously, B needs to independently trade with A and C. This means that B sometimes needs to complete one side of the transaction, anticipating the future side of the trade. Now, this means that B may sometimes need to pay A in excess of his own valuation in order to obtain the asset on behalf of C. And this also introduces the potential for C to make a lowball offer to B, who may have already acquired the asset from A. So let's think about this in the context of the legacy system. Will B ever obtain the asset for C? Well, C needs to offer a sufficiently high offer in equilibrium in order for B to want to do this. Now, there are 3 components here. You need to first offer a price that includes A's private valuation. And secondly, you need to offer a premium associated with the potential for failing at time 3. And in addition, because whenever C fails on B, B also fails on A, there's a third daisy chain premium attached to it. Now here, as the commitment problem worsens, as C is more likely to not want to return the asset back, the required price also increases as well. And this means that C starts to think about whether he actually wants to offer this fair price or not. In particular, if B already traded with A, he knows and understands that the trade is sunk, and C can simply offer B's reservation price in order to obtain the asset off equilibrium. There are 2 complications here, and there's a layer of uncertainty. First, C's not really sure if B has met with A prior to his meeting. And secondly, even if B has met with A first, C doesn't know if B has acquired the asset. Now, these 2 layers of uncertainty mean that even with a limited commitment problem, as long as it's not too severe, the set of optimal trades can be achieved with certainty. And this shows that in the legacy system, even with this limited commitment problem, the optimal set of trades can occur. Now, this brings us to the token system. And in the token system, if we think about the limited commitment problem, by assumption, actually, it's resolved. Even if C wants to hold on to the asset in the final period, whenever B and C agree and program the asset to be sent to C for the second period, the asset automatically transfers back to B. And this means that whether C is tempted or not ex post, it's irrelevant. But with this, we see that 2 new issues arise. So the first issue is the holdup problem. Now, whenever B meets with C, B de facto reveals to C that actually I do own the asset according to at time 2 because I've traded with A. So this means that even just as before, we have a holdup problem, but now with certainty, the agent can ensure that the asset that B has already obtained the asset. C's optimal offer is always to offer B's reservation price. In other words, the holdup problem is worsened. Now, the second issue is the fact that trade asynchronicity occurs. So this was actually a desirable feature in the legacy system because it created a layer of uncertainty. But in the token system, now, even without the holdup problem, B must meet with A before C in order to have the asset to actually intermediate the asset. And this means the sequence of trade matters. With the wrong sequence, trade can't occur because B has no rights to actually enter that type of trade. Now, as a result, in the token system, whenever the holdup problem binds, C fails to trade. And even if it doesn't bind, C can only obtain the asset when the sequence of trades is correct. Now, putting this together, this means that the token system improves efficiency over the legacy system only if the holdup problem doesn't bind and only if the limited commitment problem is sufficiently high. Now, together, what we're showing here is that the token system can collapse trade and settlement, completely eradicate settlement uncertainty, but it comes at a cost. And in fact, we also learned something about the legacy system. So taken in isolation, we have a very opaque trading system where there's a lot of hidden information, and also a settlement system that's incentive-based. And both in isolation seem very suboptimal. But in fact, when you put these together, it's really when you can facilitate the efficient trade between multiple traders. And this kind of shows you that carving out the settlement system and replacing it with a new system has consequences. And in fact, the efficiency of the settlement system is really tied to what type of trading mechanism that it's attached to as well. Thank you.
Awesome. Let's thank the speaker. Really interesting as well. I particularly like this observation. So the high level observation going on in the paper, which is that, we like to think that making the contract readable and verifiable on its own is sort of like enough to move us into a much better world in terms of, the transaction possibility frontier. But you're making this point that that's an oversimplified model, right? The information environment changes too once you add this instrument, and that's like really, really important. Great point. Let me quickly. I think we have time for one question if people have one. So let's pause for a sec for questions. All right, well, let me ask one also. It's a version of the same question I asked last time, which is you gave us this phase diagram. You showed us the sort of like this region where where these collapsed trade and settlement layer is worthwhile. Any idea how we would know where we are in that picture in practice?
That's a good question. And one issue is the fact that a lot of people think about the applicability of a token system in decentralized markets. What we're showing here is that when we have markets that heavily depend on intermediaries, it might not be the best system. And I think rather than thinking about whether we should apply it to certain markets or not, we need to think, well, maybe we need to also consider the design of how trading actually occurs, how matching occurs in the system in order to really unlock this potential, given that you kind of want the best of both worlds, but simply applying a token system or token environment to any type of market may not necessarily work.
Super interesting. Yeah, cool. Thanks. This is really helpful. Awesome. Let's thank the speaker once more. Applause and emotes in the chat. Up next, Simon Mayer is going to tell us about token-based platforms and speculators.
Yeah, thank you so much, Scott, for introducing. Thanks so much for the organizers for including this paper into a program. It's a nice conference. It's an honor for me to present here. So as Scott already told, I'm talking today about token-based platforms and speculators. So as we all know, cryptocurrencies and tokens are important. The cryptocurrency market has reached by now a market cap of $2.47 trillion US. I had to update this figure today because the market went down overnight. And what is also true and what was true from the very beginning is that many cryptocurrencies and tokens are intended to serve as a means of payment or as a means or as a transaction medium. For instance, Ether, ADA, the coin by Cardano, or Filecoin, or initially Bitcoin was also intended to serve as a transaction medium. However, cryptocurrencies have also become notorious for rampant speculation. Therefore, there are two types of holders of these cryptocurrencies and tokens. On the one hand, you have speculators, or more broadly, financial investors who hold cryptocurrencies or tokens for returns or as a store of value. On the other hand, you have the users of cryptocurrencies who hold cryptocurrencies or acquire cryptocurrencies for transactions. Naturally, this leads to some tension or some conflicts of interest between these two natural holder groups of cryptocurrencies. For instance, users would like to have price stability, which facilitates transactions. However, speculators would like to have some price dynamics, which allow them to earn trading returns or investment returns. In this paper, I asked the following questions. How do the speculators or the presence of financial investors affect the adoption and pricing of cryptocurrencies and tokens? And what are the potential conflicts of interest between speculators and users? And if these conflicts of interest are relevant, how do we resolve them? And more broadly, does the design of cryptocurrencies cater to speculators at the expense of users? And if so, when and why? To address these questions, I developed a dynamic model of cryptocurrencies and tokens. In the following, I referred interchangeably to cryptocurrencies as tokens, noting that there might be some differences, but for simplicity, we stick to the term tokens. Users transact with each other on a platform, on a so-called token-based platform, because a native cryptocurrency, which I refer to as tokens, settles the platform transactions. The term platform can be interpreted broadly. There need not be a specific platform on which these transactions happen. There could be also transactions within the broader crypto ecosystem. Users hold tokens for transactions, and users are risk averse because they value price stability for transactions. Speculators hold tokens for returns, and because they do not want to transact with these tokens, they are less risk averse than users. Notably, the marginal token investor who determines the price of the token can be a speculator or a user. Token and platform usage increases with expected token returns. Why is that? Well, when users can earn expected token returns by holding tokens, they are more willing to acquire tokens and to transact in the platform in the first place. On the other hand, token and platform usage decreases with token price risk or token price volatility, which is because users value price stability for transactions. In general, price stability is a desirable feature of any transaction medium, so I take this now as given. In the model, there are normal times and volatile times. In normal times, token price volatility or return volatility is low. As a result, users value tokens as a transaction medium, which leads to a high token price. Because the token price is relatively high, the expected token returns or the expected token price appreciation going forward is relatively low. Well, and a low expected token return implies that this token is not a good investment for speculators. So in normal times, there is no speculative investment. As there's no speculative investment, users take over and there is a high token or platform usage. In contrast to normal times, there are also volatile times. And during volatile times, as the name suggests, token price volatility is high. As token price volatility is high, the token does not really fulfill its transaction function anymore. So the token price becomes relatively low because users do not acquire these tokens. When the token price is low, then the expected token returns going forward, however, are high. And these high expected token returns then motivate or encourage high speculative token investment. In short, there's no speculative token investment in normal times, yet there's speculative token investment in volatile times. I classify then or identify then how speculators affect platform or token usage, or more broadly, the users. I show that speculators affect platform users via two opposing effects, crowding out and risk sharing. Let me first discuss the crowding out effect. Because speculators buy tokens in volatile times, they drive up the price. And a higher price means lower expected returns. Lower expected returns, in turn, mean a higher cost of transacting on the platform, which reduces platform usage and adoption in volatile times. However, this effect has a counterpart. As speculators buy tokens in volatile times, they drive up the price and therefore provide some backstop after a token price drop. This backstop makes users more willing to hold tokens in normal times because speculators step in, buy tokens, push up the price when there is an uncertainty shock. Therefore, speculators share and to some extent risk with users and therefore encourage users to hold tokens to transact in normal times. By this risk sharing effect, the presence of speculators stimulates platform adoption and usage in normal times. What I conclude from this is that the token investments by speculators and users are static substitutes, but dynamic complements. What does it mean? Well, at a given point in time, speculative token investment and token usage should have a negative correlation. However, over time, these two quantities should have a positive correlation in that high speculative investment today predicts high usage tomorrow and the other way around. What are the implications of these results? Well, I show that speculative investment or the presence of speculators amplifies fluctuations in token usage and adoption, can amplify price volatility of tokens, but can also stimulate platform development and long-run adoption. Is banning speculative trading in cryptocurrencies and tokens optimal? I answer this question in the negative. It can be even optimal to stimulate speculative trading on purpose. I also studied then the effects of short selling by speculators, and also this can have a beneficial effect. Namely, by short selling, speculators reduce token price fluctuations, thereby making the token price maybe more stable and stimulating adoption. I compared a token-based platform structure to other platform structures, namely to a fiat-based platform structure. In a token-based platform structure, the platform issues tokens which serve as a transaction medium on the platform. In other words, the platform earns seigniorage by issuing or by minting digital coins. The fact that the platform earns seigniorage implies that the platform can actually even be profitable without charging high transaction fees. So a token-based platform can be profitable with low transaction fees. On the other hand, a token-based platform suffers from the volatility of its transaction medium, which curbs transaction. Under the token-based platform structure, investors or the speculators, as well as users, absorb the platform-specific risk. And this relates to the previously discussed risk-sharing effect. In contrast, under a fiat-based platform, which is a platform that operates with maybe dollars or any other currency as a transaction medium, there is no seigniorage. Strictly speaking, the seigniorage accrues to the central bank, who means fiat money. To be profitable, the platform must therefore charge some transaction fees to users or adopt some other monetization models, such as putting ads on the platform or selling user data, which are abstract from in this analysis. Likely, these monetization models are not desirable for users either. However, the advantage of a fiat-based platform is that it has, by definition, a stable transaction medium, fiat money. In the fiat-based platform, therefore, the users who transact are not exposed to any platform-specific risk. All platform-specific risk is borne by the investors or speculators who act as the platform's equity holders. I compare these two structures and find that the token-based structure is actually beneficial when platform uncertainty and risk is low. And this might also, this is consistent with the relatively poor performance of the ICO market, which was dominated by, I would say, young platform firms which were facing high uncertainty going forward or were implementing unproven business models. However, this also suggests that tokenization or issuing tokens or implementing a token-based platform can be beneficial for well-adopted platforms. Finally, I introduce a so-called dual token structure with two tokens, namely a stable transaction token, also referred to as stablecoin, which is held by users for transactions, and a governance or equity token, which is held by speculators or financial investors for returns. I demonstrate that the dual token structure combines the advantages of both a fiat-based and token-based structure. Namely, the dual token structure allows the platform to earn seigniorage from minting stable coins and features, by definition, a stable transaction medium, the stable coins. In other words, the dual token structure implements perfect risk sharing between speculators and users. It seems that this dual token structure is free lunch and yields the best outcomes. However, in practice, implementing a dual token structure and in particular maintaining stability of a stable coin is challenging, and there's ample of papers demonstrating this, most notably a recently published paper by Routledge and Aria Setlin-Jones, which show in particular that maintaining stability of a stable coin without holding sufficient reserves, which is costly, is generally difficult. Let me go into the model in the interest of time. I skip some parts. In the model is set in continuous time, and there's a common discount rate, which is R. The platform is characterized by its productivity 80, which evolves according to a geometric Brownian motion. There's some drift, mu, and there's some volatility, sigma t. Notably, I assume that there are uncertainty shocks. So uncertainty can be high or low. And when uncertainty is high, then sigma t is equal to sigma b. B stands for bad. When uncertainty is low, then sigma t is equal to sigma g, and g stands for good. So high volatility is bad, low volatility is good. And there's some stochastic transition between these two states, and there's some transition probabilities. And then the token price also loads on these on this uncertainty and moves according to these uncertainty shocks in a way we characterize. I assume that these tokens fulfill some transaction function on the platform, and I model transactions in reduced form by adopting the well-known money in the utility function approach. Specifically, any user, and there is a unit mass of them, derives some utility or some convenience yield from holding tokens, which is reduced form modeling of transactions. In particular, the utility a user derives from holding UIT dollars in tokens is given in 1 and consists of the convenience yield, the token returns, but the utility a user derives from holding token decreases with the opportunity cost, which is the interest rate R, and some disutility of bearing risk. And this reflects that users value price stability for transactions, simply reflecting that price stability is a desirable feature of any transaction medium. And the risk aversion of users is actually governed by the parameter pi. As I model platform transactions in reduced form, the transaction volume essentially in dollars is given by the aggregate token holdings of users. And then we can go through the maximization. The users optimally decide how many tokens to hold, how much to transact on the platform. And doing some algebra, we arrive at the platform transaction volume VT in equation 3. And then the exact expression is not super important, but like simply the following 3 observations suffice. Well, platform transaction volume increases with expected token returns. Why is that? Well, when users can earn token returns while holding tokens, the opportunity cost of holding tokens becomes lower. So users are more willing to hold tokens and, in our reduced form interpretation, to transact on the platform. Platform transaction volume also increases with platform productivity, which captures the technology of the platform, and decreases with token price volatility, which captures the user's preference for token price stability. Just some wording. VT, the platform transaction volume, is simply simply quantifies platform or token usage or adoption. Next to users, there are also speculators, and speculators, unlike users, do not derive a convenience yield from holding tokens, but simply derive utility or would trade for returns. That is, speculators' instantaneous utility or value from holding tokens or payoff from holding tokens consists of token returns, net the opportunity cost of holding tokens, and net some disutility of bearing risk, because speculators might be also risk averse. But the key assumption is that speculators are less risk averse, which reflects that speculators don't use tokens, so they don't have a transaction-based motive preference for price stability. So speculators also face a short selling constraint, which I shall relax later in the analysis, but not today. We won't see that. So the key equation is equation 5, or like the key inequality essentially states speculators hold tokens if and only if expected token returns are sufficiently high and compensate them for their time preference R and disutility of bearing risk. We can solve this model then essentially, and at the core of the model is the following token pricing equation, which is equation 6. And I think this is interesting to discuss a bit further, because equation 6 resembles a traditional valuation equation for financial securities. How is that? Well, the left-hand side is the financial investor's required return, which is essentially the interest rate R plus the required risk premium. On the right-hand side, we see expected token returns. The interesting term is the one in the max operator, which is the risk-adjusted convenience yield to holding tokens of the marginal investor. And this term is 0 when the marginal token investor is a speculator, because speculators do not hold tokens for transactions, so do not derive convenience yield. And this term is positive when the marginal token investor is a user, and the users derive a convenience yield. I make some more assumptions then throughout the analysis that makes this model tractable and parsimonious, and essentially everything scales in platform productivity, and the only thing we have to keep track of is the current state, the current volatility. So that is, do we have high uncertainty? Do we have low uncertainty? Are we in state B with high uncertainty, or are we in state G with low uncertainty? In other words, there are normal times in which uncertainty is low, and there are volatile times in which uncertainty is high. And these two terms are just how I call them. The first result is essentially then in normal times, the price is higher than in volatile times, which reflects simply that in normal times, the token is more useful for users to transact. And the following graph essentially depicts then the main forces at work, or like the main effects. What do I do in this graph? Well, I plot the token price, or the scaled token price, because everything scales in A, against the parameter theta. What's the parameter theta? Well, the parameter theta governs speculators' risk aversion, and serves therefore as a proxy for speculative investment. So the lower the parameter theta is, the higher speculative investment. Put differently, as we vary the parameter theta, we essentially generate some more or less exogenous variation in speculative investment. This helps us identify the impact of speculators on platform adoption, which is characterized by VG and VB in state G and B respectively, and the token price PG and PB in state G and B respectively. So as speculative investment increases, which is when theta decreases, platform usage, adoption, and transactions in state B decrease, but platform usage, adoption in state G increase. So like this here is a typo. And speculative investment always increases the token price. Why is that? Well, there's just additional demand for tokens, so the price must go up. So speculative investment in state B drives up the price in state B, and therefore reduces expected token returns. As a result, speculators reduce expected token returns in volatile times, yet they increase expected token returns in normal times. And why is that? Well, then speculators essentially provide some backstop when the price drops. And in particular, this happens when the system transitions from normal to volatile times. When speculators buy and the price drop is not so bad. And that implies then that token returns are higher in normal times. What I talked at the beginning about the effects of speculators, I classify them as crowding out versus risk sharing. What is the risk sharing effect? Well, the speculators provide some backstop. In volatile times, speculators buy tokens, absorb price volatility, and boost the token price. And this decreases token returns in volatile times, but increases token returns in normal times. And because token returns in normal times are boosted by the presence of speculators, speculators also boost platform transactions, usage, and adoption in normal times. At the same time, when speculators buy tokens, they crowd out users because they increase the price, reduce expected token returns. Lower expected token returns imply a worse return to risk trade-off to holding tokens. And this worse return to risk trade-off reflects then back into a lower transaction volume.
Simon, we're running way over time, so if you could wrap
okay,
up
so sorry. So like, let me quickly
5 seconds.
conclude. In this paper, I develop a dynamic model of cryptocurrencies and tokens, which features both users and speculators. Speculators affect users via two opposing effects: the crowding out effect, which is negative, and the risk sharing effect, which is positive. I discuss also other platform structures, namely a dual token structure featuring a stablecoin and governance token, which we see it quite frequently nowadays in decentralized finance protocols. And this dual token structure implements perfect risk sharing between users and speculators. Thank you so much for your attention. And
Awesome.
very much sorry for going over time. Hello.
No worries. Thank you so much. Super cool. As we're running a little bit over time, so we don't have time for a question, but I will say that that paper feels extremely, sort of close to home for anyone who was buying on Ethereum over the last 2 weeks. Very, very accurate and heartfelt. Let's get some applause emotes in the chat. And then we will move on to our last speaker for the session and for the day, Rowena Gan, who's going to tell us about To Infinity and Beyond financing platforms with uncapped crypto tokens.
Thank you, Scott. Good afternoon, everyone. I'm Rowena from the Cox School of Business at SMU. And I'm really excited to share with you my work on how to use uncapped initial coin offerings to finance P2P service platforms from an operations perspective. So this is joint work with Jerry Tsoukalas from Questrom School of Business at Boston University, as well as Sergey Nedison from the Wharton School at UPenn. So we thank the organizing committee for giving us this opportunity to share our paper with all of you. Can you see that my slides, I have changed to the next slide?
Yes.
Oh, okay. Thank you. So first of all, initial coin offering is essentially a fundraising method whereby firms raise capital through selling tokens. So in a typical ICO, a firm first publishes a white paper which describes the product, the details of the fundraising process, how the token works, etc. The tokens issued by the firm are platform-specific tokens. And the most common type of the token is called the utility tokens that are used for consumption of the company's products or services. And they're usually the only viable method of payment for those products and services. Another popular type of token is the security tokens, which represent ownership of an asset, such as the company's future revenue. Regardless of the token type, during the token crowd sale, investors purchase tokens using fiat currencies or cryptocurrencies such as Bitcoin and Ether. And these Bitcoin and Ether are sent to a published address. And a smart contract basically sends the platform-specific tokens back in return. The firm, after selling its tokens, will basically be able to fund its project. Now, most existing studies on ICOs focus on capped ones, but in our paper, we focus on a different type of ICOs called uncapped ICOs. So by uncapped, I mean that there's no artificial ceiling for the total amount of capital raised. So this means that either the price of the token has no upper bound or the number of tokens sold is unlimited. And in this talk, we aim to understand how uncapped ICOs can fund service platforms under network effects. The model in our paper is most similar to the Ethereum model, which had a single round of uncapped ICO, and new tokens are being minted on a regular basis and are given to miners. So with this paper, we explore and answer the following questions. The first one is how to design an uncapped ICO. So this includes the firm's decisions on the ICO token price and setting the service level, and also the future token policy. And then we ask, when do uncapped ICOs succeed? So by success, we mean the ability to raise any positive amount of money. And third, we ask, is uncapped ICO the right way to go? Would adding a cap serve the firm better? And we also ask, what impact does regulation bring? And last, we ask if there's a better way of doing an ICO. Should the firm charge a platform commission? Is it better to issue just utility tokens or multiple tokens? This paper contributes to the OM finance literature and is closely related to the ICO literature on P2P platforms. And our paper differs from these existing papers by studying uncapped ICOs rather than capped ones. Note that what I'm showing here is just a subset of the related literature. I'm sorry if I'm not including your most exciting work there, but we provide a more complete list in the paper. So now, let's take a look at the model. We have a highly stylized model. It is a multi-period model. We have 4 agents. So first of all, there's a firm that builds and operates a service platform that brings together 2 types of users, the service providers and the customers. The firm incurs a fixed setup cost of $C. It is a responsible firm as it develops a platform as long as the ICO proceeds can cover the setup cost. Otherwise, it just returns the money to the speculators. The firm's decision include the ICO token price and the future token policy, which is basically the number of tokens to be generated each period. And then we have a group of speculators. They're risk neutral, and they arrive sequentially during the ICO, and they collectively purchase M tokens at the price tau 0. If the platform launches, they sell their tokens to the first period customers at equilibrium price tau 1. If not, they just get their money back. So these speculators only purchase tokens if they believe they can make a non-negative profit. And they would stop purchasing when it is no longer profitable for them to buy more tokens. Now, on the user side, there are customers and service providers. So we assume that there's a finite market of customers of size M in any single period. Customers have idiosyncratic valuation of service. Each one receives 1 unit of service, and he or she pays the service provider P dollars, but in the form of tokens. And they enjoy some network benefit, which is in a quadratic form of the service level. So here, this K basically represents the network effect coefficient. Then there is a large pool of service providers who arrive simultaneously. A service provider can either provide service at a fixed unit cost C or be idle. And their reward will be in the form of tokens, and that they get tokens from the customers who they serve. And they also get tokens from the platform if new tokens are minted. So let's now look at the sequence of events. Period 0 is when the ICO takes place. So the firm announces its decisions and sells tokens to speculators. Now let's assume that the firm raises enough money so it builds the platform. So in period 1, the platform has been built and the customers and service providers join the platform. Speculators sell their tokens to customers in period 1 at this equilibrium price tau 1, and S1 units of service are provided to S1 customers. Each customer pays P of S1 over tau of S1 tokens to a service provider, and each working service provider also receives Z over S1 tokens from the platform. These are the newly minted tokens, and they will sell all of their tokens in period 2. So similarly, in any subsequent period T, service providers in the previous period sell all of their tokens to customers in the current period. And service providers of this period will sell their tokens in the next period. And note that all agents act simultaneously in any single period. And we find, first we find that such uncapped ICOs will be successful if and only if the initial setup cost of the platform does not exceed the future cash flow of the platform in each period. So here, this S sub SS star represents the steady state service level, or the number of units of service delivered per period in the long run. And this is an equilibrium result. So if this condition for ICO success is not met, there will be no feasible solutions for the ICO token price. Now, one may wonder if putting a cap would have any positive impact on the firm's profit. And the answer is no, because this M, which is the total number of tokens sold in the ICO, does not affect the service levels. So putting a cap basically leads to a transfer of profit from the firm to the speculators. That's why it is in the firm's interest to remove the cap or to sell as many tokens as possible. So here we just looked at the base model in which the firm does not keep the ICO proceeds if the ICO proceeds cannot cover the platform setup cost. And next, we consider two other, we extend the base model that we just looked at to incorporate two scenarios. So the first scenario is that we consider a more realistic case in which ICOs are poorly regulated, such that the firm actually keeps the ICO proceeds with or without developing the platform. Another feature is a platform commission, which is basically a fraction of the customer's payment that goes to the service providers. And this is not only in line with practice because most platforms do not operate free of charge, but also, as our model shows, is critical in terms of incentivizing the firm to develop the platform. So we consider four firms. Firm 1 is regulated, but it does not charge a commission. Firm 2 is not regulated, but it does charge a commission. Firm 3 is doing neither, and firm 4 is basically both regulated and is charging a commission. So if we compare firm 1 and 4, we find that collecting commission increases the firm's profit, and that is very intuitive. And then by comparing firm 2 and 3, we find that the platform commission incentivizes the platform development even in the absence of regulation. But the existence of a platform commission hurts service providers in some circumstances, as it gives the firm more leverage to extract their profit. Now, if you look at firm 1 versus firm 3, then we find that regulation can serve as an alternative to platform commission that secures the firm's effort in platform development. Among firms that do charge a commission, which are firm 2 and 4, we show that having regulation in addition makes ICOs more accessible, especially for responsible firms with higher platform setup costs. And lastly, firm 1 versus firm 2 tells us that when each of platform commission and regulation is put into effect independently, platform commission is a more effective profit booster for the firms, whereas regulation benefits service providers more. So, so far, we've looked at ICOs that issue utility tokens only. Next, similar to Simon's paper, we also study the dual token model, but with a slightly different setting. In our context, the firm sells security tokens during the ICO, and the security token owners get a share delta of the firm's future revenue. Then customers and service providers use stablecoins for transactions, and the value of the stablecoin is basically fixed. So we modify the firm's profit function by adding a factor 1 minus delta. Oops. Okay, so comparing these two models, we find that the value of delta, which is the share of the firm's revenue, determines whether the dual token model is more likely to succeed, and also determines if the firm will collect more ICO proceeds under the dual token model. However, regardless of the value of delta and basically other parameters, as long as the success conditions are met, the traditional utility token model actually leads to a higher profit. So for firms with relatively lower setup costs, they're better off just issuing utility tokens, whereas firms with higher setup costs might prefer the dual token model. So this is all I have for you today. Thanks a lot for staying. Thanks a lot for your attention. And we look forward to hearing your thoughts and questions. Thank you.
Super cool. Let's, thank the speaker and get some applause emotes in the chat. Totally fascinating that this like uncapped ICO opportunity seems to have just been like totally missed. And, I think both to some degree in practice and then in large degree, just, and then, as you've talked about, like, almost 100% degree in terms of like what we've been studying and thinking about. So really cool. I think in the interest of time, we're going to take discussion and chat to the breakout rooms offline. But let me just quickly say, this was a completely fantastic session. I really appreciated all four speakers, incredibly clear presentations on really strong and sharp, intuitions. Totally fantastic. And thank you so much. So let's thank everyone once more. Applause emotes, and then please hang out and break out in the breakout room.